The Fed may be creating another problem for itself. That's coming up on 3 Minutes on Markets and Money. An interesting development is occurring. We have to go back to the 2008 financial crisis when the Fed started doing quantitative easing. Now, just for a quick primer, how does quantitative easing work? First of all, the Treasury issues debt in order to pay for spending above revenue. Now, interestingly enough, today it takes more than 100% of the revenue that comes in from tax dollars just to pay for Social Security, Medicaid, Medicare, and interest on the debt. So any new spending, like the Inflation Reduction Act as an example, has to be issued by debt. So the Treasury issues bonds to the 20 primary dealers, which are basically the banks. They buy the bonds. And as they buy the bonds, they're supposed to be then selling those off to customers, clients, whoever else, and that is moving the system through the economy. The interest is then paid to those bondholders over time. Well, starting in 2008 and 2009 with quantitative easing, the Federal Reserve enters the picture and starts buying the bonds from the banks. And so as they buy bonds from the banks, they then credit the banks back with excess reserves. And these reserves are supposed to be lent through the system to corporations, etc., in order to strengthen the economy, right? But that never happened. The banks simply just kept the money and used it to do prop trading and run up stock prices. Now, the interesting thing occurs here. Those interest payments that the Treasury pays out is an expense now to the Federal Reserve. So this expense goes out to the Federal Reserve. The interest is brought in by the Fed. At the end of the year, the Federal Reserve then remits those interest payments back, or at least a portion of them, back to the Treasury. Now, this accounts for billions of dollars a year, $20-30 billion a year in these remittances back to the Treasury. So the Treasury has an expense going out and a revenue stream coming back in, recycling the exact same dollar on each of those bonds that have been now put through QE. Now, here's the problem, though. The rise in interest rates is now causing an issue for the Federal Reserve. Those net remittances, now remember, the Federal Reserve is now paying interest on those excess reserves sitting at the bank. So as interest rates go up, the interest payments on those excess reserves are going up. So now the Federal Reserve now has $500 million worth of payments going out every day to these banks in terms of these interest reserves. This is now greater than the income coming in off of the balance sheet, which now requires the Treasury to issue more debt in order to meet the deficit in the interest payments back to the excess reserves. So now as the Fed continues to increase interest rates, quantitative tightening is causing another problem, forcing the Treasury to issue more debt at a time where, well, we just don't have the revenue to cover the interest payments on the debt anyway. So this is just compounding another problem we have with too much spending in the economy, a greater deficit, and of course, the larger the deficits that we have, the slower the rate of economic growth that we get over time. So it's very interesting here. The Fed is creating another problem that they're going to have to solve on top of the problem of inflation that they're already trying to solve by hiking interest rates. There's no free lunch in the financial markets. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.